Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right now is at about 6,047. That's up about 3% year to date, and up an impressive 21% since the lows that we set back in April. So, if you defined April as a bear market, we have now entered the bull market on the other side of it, which is an interesting little bit of trivia. We had a little bit of drama over the weekend in the markets due to the Israel-Iran conflict. So markets sold off a little bit on Friday, notably on Friday. We're getting a little bit of that back here on Monday. And, the comment that I would make for those of you who have sort of seen these sort of updates before or have been through one of these conflicts before is that the market will generally shake this off unless the conflict starts to impact something that matters to the world economy. And once again, this is the sort of, we aren't bad people. It's just the market's incredibly rational and focused only on economics to the exclusion of everything else. So a regional war doesn't really matter to the market all that much unless it starts to impact somebody's economics in some way, shape, or form. When you're dealing with Israel and Iran, the most obvious way in which the market might get impacted is via oil. And there are a whole host of reasons why the Israelis are not targeting any of Iran's oil facilities. If you think about it, they've been able to achieve a lot of their military goals without necessarily going after Iran's economy, so to speak. And the rest of the world would very much appreciate it if, in particularly the United States, if Israel didn't mess with Iran's oil facilities. So there's really a whole host of reasons why, if I were a betting man, I would bet that Iran's oil exports get left alone in this whole conflict. And so long as that maintains and stays the case, then the markets will kind of roll over it without being too much of a hiccup. Meanwhile, on Friday, we got an update to consumer confidence numbers, staging a little bit of a rebound, up to about 61 for Michigan consumer sentiment off the sort of low 50s. Still a low number, but nice to see that consumer confidence number moving in the right direction and really driven by an improvement in the sentiment around inflation. It does seem like we are not seeing wild spikes in inflation as a result of the tariffs. Once again, tariffs are still very much in early days, but at least currently doesn't seem like we're seeing too much of a spike in the CPI as a result of inflation. And that brings us conveniently to the Fed, who has a meeting on Wednesday of this week, where it is wildly anticipated that they will leave everything exactly the same as it is now. That they will take a little bit of a wait and see approach, not move towards stimulus, not move towards any type of more restrictive policies. In fact, if you look at sort of forward interest curves, the market not really pricing anything in terms of Fed action until all the way out in October. A very, very flat wait and see expectation out of the Fed. 10-year Treasury rates right around 4.4% and have been stable there for at least the last couple of weeks in that sort of 4.5% to 4.4% range. So other than the Iranian conflict, really kind of a quiet time in the marketplace, which is certainly appreciated as we head into the summer. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I look forward to talking to you again soon, and I hope you're having a great day.